All right, so welcome to an options rapid fire segment. So in this segment, what I do is take a look at a handful of different stocks and just give you some ideas of how I would trade them or what type of strategy or position I might put on. Again, remember when we look at these kinds of things, everybody's a different type of person in terms of, are you a long-term investor? Do you only go long? Do you go long and short? What strategies do you know? How do you manage risk? Is it long-term, short-term? So that's going to be a variable for everybody. Lots of variables out there. So keep that in mind as we go through this, but at least the goal is to open up your mind and give you some things to check out. So what we're going to do is we're going to go ahead and check these few stocks out. We're going to go ahead and start with kind of a bigger daddy of them all. We're going to go with Apple. So Apple's been trending higher, and just looking at this one, it's been kind of moving to the upside. So I think a simple approach for this would be the way to go. We do have earnings on 7/27, so keep that in mind that as we go through these, I'm kind of negating a little bit more on the earnings. So I'm going to go into Apple, and I think the simplest approach to something like this is maybe going out. I think 46 days is good because we get a little bit of more range because the stock is a little bit toppy, and I would just go in and picking a delta of around 13, sell this one, and I would just buy something super cheap so it just cuts the capital out. So it's basically a cash secured put when you think about it, but I am cutting the actual capital at risk by buying something extremely cheap over there. So it's only $3,391, but pretty much it's just a selling a put a single way further out. And if it continues to go down below that 170, I would get a sign. So that's kind of the approach I would take with this one when I look into Apple. Okay, going to the next one. Okay, so that's number one. Going into the next one, we're going to go check out Meta. And Meta also is very high, but I would trade this one actually a little bit differently. This stock is, pulling it up here, this stock is kind of really trending higher, and it's done extremely well since over here about a year ago. So we were like at 95, now we're like at 300. Holy smokes, right? So it's been doing really well. I would actually take a cheap shot or bet that maybe this thing could pull back again at a lower level. So how might I approach this? Again, we do have earnings, all that stuff, okay? But let's just say, okay, I'm going to take a cheap bet on it, on maybe a calendar bomb or a butterfly bomb, somewhere on the lower end. So we could go in that area, or the other approach I could do is a protected vertical. So the way I would do that is, let's do a protected vertical. Let's go about 46 days out. Very similar to Apple in this case. I'm going to go a little closer in though. Okay, so assuming it's still going bullish, okay, assuming it's going to continue to move up, right? Because I have much more folks that are longer term investors than shorter, than people that are just, active traders or something like that. So in general, most people are like long for a certain stock, or meaning they want it to go up. So what we could do is, let's say we've got 10 contracts here, and we've got these positions. What you might actually do is switch this to a custom trade and then go ahead and buy an extra put. So now I've got myself an extra put, and that'll curve my downside just in case. So now I'm still looking for that stock to head higher, but I do have that put. The theta will start a little bit negative at the start, but then it will pick up speed. And if the stock continues to head higher, then you should still be okay. So this is kind of the approach I might take on this type of stock. Again, paper account, I'm just throwing out some of these trades just to get some things cooking. All right, next one I've got on the list, we've got Carvana. So this is a fairly popular stock. One thing I'm looking at is this stock is breaking this $20 range. It's trending higher and so on. Selling premium on this, I don't know if it's worth it in those cases. So what I might do is throw in a couple of different trades on this. So we'll pull up Carvana here. And then the way I would approach it is, again, look at the earnings though. You usually will want to stay away from the earnings, but I'm going to just, again, forget about earnings for a minute. Something along those lines is, if I'm a long-term investor, I would buy a few, let's buy some of these that are at the money. We'll go vertical here. So now we'll get Carvana, and we'll switch to a float. So we'll do 2 of these contracts to start. Okay, well, maybe 3 for now. So I've got some on August 11th, so I'll throw a few of those in the mix. Then I would also throw, because it's a cheaper stock, I'd throw maybe a 46-day one, but I'll go a little out of the money. Okay, and what the out of the money things do is they don't cost you as much, but if it works, you make more money. But they're less likely to work out because you need a little bit more of movement in the stock. So I start over here and then I need movement. Whereas the ones in the money, or kind of, sorry, not in the money, but at the money, they kind of have a better probability chance of those things working out. So I'm going to go ahead and let's say let's do 4 of those in there. Let me cancel and replace these other ones while I've got it on the 32 here. We'll do maybe, let's go 30, 31 here. We'll go like this, try and replace those, see if I got filled. Maybe I didn't. August 11th, did I already get filled on that? Yeah, I already got filled, that's fine. Okay, so I got filled on some of them. So cheap shot there, you know, it's only 120 bucks. And then the other ones are kind of filling, so I've got a few out of the money. And then again, if I really believe in the stock, maybe a 130. You know, this is like taking a long directional bet at a 35, and they don't have a lot of options. That's a bit of the problem here. So I even go into a 193. So this is again a super cheap shot here, going further out. You don't get to make, you don't have to pay up a lot for these options, but it needs some movement. So if you really believe in the stock, look, I'm only putting up like 58 bucks, but if it does really work out, you could make maybe 190. So I wouldn't throw a lot of capital into those. And let's just check. We got a 40, maybe a 37 and a 40. That would be the approach. 37 and a half and a 40. So now if it moves, I'll be fine. But it needs movement. But again, I'm only doing one contract on those. So a little bit more at the money, I'll put more money in, a little bit out of the money, a little less money. And that's maybe the approach I would take with that one. Okay, let's go to our candidate number 4. That is CVS Health. Okay, so pulling up CVS Health. If we look at this one's been trending lower quite a bit. So it's one of the reasons why I kind of like this one to, hey, let's take a shot at it, because it's been trending lower, whereas the market itself has been, you know, it's more in the tech companies and so on. So this is a little bit of a different outlier. It's not the same stock. But to take a cheap shot on this one, maybe go, let's just start again 46 days out. I'd actually do a little bit something more like a butterfly right here. And let's see if it will kind of work out in this case. And the reason the butterfly is it's a cheap shot, cheap bet for if that stock does head higher. It's a little bit more of a, call it a broken wing butterfly. So kind of like a vertical. So I'm just looking for a pop, but I'm risking less capital than a vertical would. So by doing a butterfly, I risk less capital. If it kind of hangs out there, it still wouldn't cost me as much. So, but I still get a little directional move to the upside. So I could throw a couple of those contracts in there, and now you're risking about 500 bucks. And if it pops, you know, you might make 150 or so, give or take, somewhere there. So it's not too bad. So something along those lines is maybe what I would do and throw on that type of trade for CVS. All right, last one, and we will go with Netflix. Okay, so Netflix is kind of an interesting candidate. I would actually probably short Netflix here. And the reason is it's a little toppy. It's creating a double top right here. And in order for me to short this, though, I would probably short with a butterfly. But instead of doing a butterfly, we're going to do a calendar, because it's like a calendar bomb. That is because with a butterfly, you got the Vega risk. So I'd rather do a butterfly on the upside, maybe a calendar on the downside. So when we look at Netflix here, the way I'd approach it, and again, you've got earnings coming out, so it's a little bit of a pain. So I probably wouldn't, I wouldn't really even put on this trade right now because I've got earnings on 7/19. But if we forget earnings, I'd throw some of those trades down here in those levels. And the way that I would approach it is, let's say I've got a 39-day over here. The expected move is about 50 points, so somewhere around a $400 area. Let's see if we can do it, if the calendar will actually price okay. And yeah, so something like this. So we've got a little bit of a calendar here. Let's throw another one, like a cheaper one at 380, because now I've got some more calendars in different positions. I'm just kind of looking for it to just kind of, hey, sell off in a big way. And then I'll do like another calendar, maybe around 430. So what we've got is a few calendars positioned, and as it goes into that area, we're looking to kind of take them off. So as it goes into about a zero delta, so it's basically a negative position. I got calendars structured all over, where if it doesn't move much, I collect some theta here. If it moves a little bit, I get this calendar and this one kind of as it goes through. If it moves a lot, I get this one, and this one. And if it goes really far, I'll collect money through all of those calendars. But the one way out there doesn't cost me as much. At the 360, I'm only paying 53 cents on that calendar. But, it's not expensive, but the chance of it hitting is not realistic. So probably maybe structure something like this. I could also structure it at different expirations. That might be a smarter approach. But for video purposes for now, I'm just going to keep it simple like this. And, with just a handful of contracts and keep it in this way. So that's basically my thought process for how I might approach these kinds of positions and some of these strategies and so forth. Hopefully that makes sense for you. Definitely appreciate you sticking with me, and maybe it gives you some things to think about as you go into doing your own trade strategies, putting on some positions, and maybe how you would approach it. Again, my opinion is going to be probably different than your opinion, and that's fine. There's nothing wrong with that. It's just the whole point is to get you to open up your mind and see, hey, how might we trade this? And this is one way of doing it. There's probably thousands of other ways to do, a trade on the same vehicle or same stock, simply because you might see something different, or you like different strategies, or you might manage it a little bit different. So anyways, truly appreciate you sticking with me. Thanks again, and I will see you next time.